What if the news that makes your stomach drop is secretly the best news you could get? We're conditioned to see the word recession and immediately think of loss. We picture red arrows on a stock chart, headlines of economic winter, and the universal fear of our savings evaporating overnight. It feels like a storm on the horizon that we're powerless to stop. The conventional wisdom is simple: get out, sell everything, and hide until the sun comes out again. But this reaction, this primal instinct to run from danger, is built on a fundamental misunderstanding of how wealth is truly created. A recession isn't just a period of economic decline. For those who can see through the fog of fear, it's something else entirely. It's a clearance sale. It's a reset. It's an opportunity so profound that it has historically minted new generations of millionaires from the ashes of the old. So, what if the panic isn't the problem, but a symptom? What if the real danger isn't the recession itself, but our reaction to it? In this video, we are going to deconstruct the anatomy of a recession, not as an ending, but as a violent and necessary beginning. We'll explore why the moments of maximum pessimism are often the moments of maximum financial opportunity. By the end, you won't see economic downturns as a threat to your wealth, but as the single greatest catalyst for building it. We'll move past the fear-mongering headlines to understand the mechanics of the market cycle and answer the one question that matters: how can something that feels so bad be so good for your future? The story we're all told is a simple one. The economy is a machine that should always go up. When it sputters, when it shrinks for 2 consecutive quarters, we call it a recession, and it's treated like a failure of the system. We see images of the Great Depression, of the 2008 financial crisis, and we're taught that these are periods of pure economic destruction. The news reinforces this narrative every single day. Headlines warn of a looming downturn, analysts predict more pain ahead, and the prevailing emotion is fear. The stock market, we're told, is a reflection of this reality. When the economy is bad, stocks go down. End of story. And for the most part, in the short term, they're right. We see our portfolios shrink, and the instinct to sell becomes overwhelming. It feels like the only logical thing to do. But if this story were the whole truth, how do we explain the paradox that lies at the heart of long-term wealth creation? Warren Buffett famously advised investors to be fearful when others are greedy, and greedy when others are fearful. This isn't just a clever quote. It's a direct contradiction to the survival instinct that a recession triggers in most of us. If a recession is simply a time of loss, why would the most successful investor in history advocate for running toward the fire, not away from it? What if this common narrative, the one that tells us to panic, is actually a trap designed to separate the patient from their money? To understand this, we need to look at a recession through a different lens, not as a failure, but as a function. Let's use the economic concept of creative destruction, popularized by Joseph Schumpeter. Imagine an overgrown forest, filled with old, sick trees and tangled underbrush that choke out new life. A wildfire, while terrifying and destructive, is the forest's brutal but necessary cleansing agent. It burns away the deadwood, clears the canopy, and enriches the soil, allowing a new, healthier and more vibrant forest to grow in its place. A recession is the economy's wildfire. During the boom years, cheap money and easy credit allow inefficient, bloated, or simply bad businesses to survive. They are the sick trees, soaking up resources that could be used more productively. A recession raises the cost of capital and dries up consumer spending. It is the event that finally starves these zombie companies of the fuel they need to live. Their failure, while painful, releases their resources, their employees, their capital, their market share, back into the system to be reallocated to stronger, more innovative companies. The 2008 crisis wasn't just the end of Lehman Brothers. It was the fertile ground from which companies like Uber and Airbnb grew, companies built for a new, more efficient world. The recession wasn't a destroyer of value, it was a brutal reallocator of it. But let's be clear, this isn't just an abstract economic theory. The fire is real, and it burns real people. Companies go bankrupt. Lifelong employees lose their jobs. Families face genuine hardship. This is the undeniable human cost, and it's the reason recessions are so feared. It feels wrong, almost predatory, to see this pain as an opportunity. This is the great contradiction at the heart of the downturn. The macroeconomic reset that is so healthy for the system in the long run is built on microeconomic pain in the short run. So if the destruction is this real and this widespread, how can it possibly be framed as a net positive for an investor? To answer that, we have to look past the companies that die and focus on the ones that are left standing. The companies that survive a recession are, by definition, the strongest. They have responsible leadership, a healthy balance sheet, a loyal customer base, and a genuine value proposition. They are the resilient sequoias that withstand the fire. And the incredible thing is, during a recession, the market, in its panic, cannot tell the difference between a sick tree and a healthy one. It just sells everything. This indiscriminate panic selling pushes the stock prices of even the world's greatest companies down to levels that would be unimaginable during a bull market. You get the chance to buy the best businesses on earth at a massive discount. Think of the dot-com bubble in 2000. It was a wildfire that burned thousands of worthless internet companies to the ground. But in the blaze, Amazon's stock fell over 90%. The market was pricing it for bankruptcy, treating it like just another piece of deadwood. Those who understood that it was a sequoia, not a weed, and bought in during that period of maximum fear, participated in one of the single greatest wealth creation events in modern history. Of course, I know what you're thinking. This all sounds great in hindsight, but timing the market is impossible. What if I buy, and it just keeps falling? What if this time is different? This is the ultimate fear, the one that paralyzes even savvy investors. It's the search for the perfect bottom, the absolute lowest point before the market turns. And here is the secret. You will never, ever time it perfectly. And you don't have to. The deconstruction of this fear reveals that the goal isn't to be perfect, it's to be present. Trying to catch the absolute bottom is a fool's errand. Instead, the strategy is to acquire quality assets at prices you know are cheap from a historical perspective. Even if you bought Amazon stock halfway down its 90% fall, you would still have made a life-changing return. The real risk is not buying too early. The real risk is being so paralyzed by the fear of a lower price that you miss the recovery entirely, which often happens faster and more violently than the crash itself. Your greatest virtue in these moments isn't timing, it's temperament. Even the act of buying at a discount was, in reality, a vote of confidence in the future. So let's assemble the full picture. The headlines scream panic. This fear creates a wildfire in the market that burns indiscriminately. This fire cleanses the economy of its weakest and most inefficient companies, a painful but necessary process of creative destruction. In the chaos, the market offers the world's best, most resilient companies at prices that are divorced from their actual long-term value. The breaking point, the moment of maximum opportunity, isn't a number on a chart. It is the point of maximum human pessimism, when everyone is finally convinced that the storm will never end. This is the signal. This is the invitation. Now that we understand the machine, we see that the end of a recession isn't just a recovery. It's the beginning of a new cycle, led by leaner, stronger, and more innovative leaders. The only question left is a psychological one. When the world is telling you to run, will you have the courage to walk toward the fire?